Hello and welcome guys to the sixth video in our series on economics, and as you can tell, this one's going to be about investment and finance. So what is investment? Basically it's taking the savings that comes from unconsumed produce, produce meaning that which we produce, and repurposing it toward an expansion of the productive processes. This function, combined with the division of labor, is responsible for all of the wealth in the modern world, so it is imperative that it operate correctly. Investments which go toward improving production or expanding commerce either make everyone wealthier or increase their access to said wealth. We say this now bearing in mind the caveats outlined in our chapter on trade regarding capital mobility in a country's stock of capital. Investment can come in two forms, equity or credit. When people invest in a company using equity, they buy shares in the primary market. When people invest in a company using credit, they loan money to it or buy bonds from it. What is a primary market? It is the market on which companies issue new shares. The NYSE and NASDAQ are not primary markets. They are secondary markets. Therefore, none of the proceeds of the trades committed on these stock exchanges go toward financing the original issuing company's operation. Only stock purchases on the primary market help the company finance its operation. Since the secondary market in general dwarfs the primary market, the true purpose of the stock market is not to help finance businesses. Its purpose is to give people a place to put their savings and have them grow. If none of the exchanges on the stock market serve to finance the expanding operations of said companies, then where does most of it come from? Initial public offerings, also known as IPOs, do serve this purpose, but mostly it is credit extended to the non-financial sector, or those companies simply issuing their own bonds. So the secondary market is essentially an enormous segment of wealth which is trapped away and not really having any effect on businesses. And the only purpose it serves is to give people a place to put their money so that it will grow when they're older. Basically, the purpose it serves is for increasing pension funds and things like that. Okay. So yeah. Unfortunately, most of the investment capital in the United States is not directed towards financing the expansion of businesses. Most of the investment capital in the United States is directed toward the stock market or toward financing household consumption. Why is this bad? Well, let's examine two scenarios. The first is one in which capital is directed towards industry. In this case, industry is allowed to expand its operations and possibly reach economies of scale, which permit it to outperform its international competitors. This is good. This makes it more profitable, and it can afford to pay its workers higher wages. It sells its products, its workers buy products with their high wages, and in a general sense, prosperity has increased. The second is one in which capital is directed towards secondary markets and household consumption. Right off the bat, if capital is directed towards secondary markets, this means that the real economy is deprived to some degree of credit. The capital and its purchasing power will be locked away in the stock market, where it can't help anyone, at least not in the short term. Secondly, when the remainder of the credit goes toward financing consumption, this isn't good either. This type of activity does not promote expansion. It promotes expanded demand within an economy, but doesn't promote the ability of the economy to actually expand. If credit were allocated to the top, on the business end, then the businesses could use it to take on more laborers, which means higher demand, and increase production, which means higher supply. This means more wealth for everyone. But when credit is allocated to the bottom, on the household end, higher household consumption is enabled. but it places an interest burden on the household. That higher ability to consume could have been born out of increased wages and higher supply of goods, neither of which have any downsides. But instead, in this scenario, it comes with an interest burden attached. The former, higher wages and higher supply of goods, thus higher standard of living in general, and the latter, higher demand engendered by debt at the same level of wages and the same level of productivity and productive capacity. This type of lending is less beneficial to both households and businesses, but more beneficial to banks. Consumption credit, mortgages, auto loans, credit cards, etc., comprises the majority of the bank's lending activities. Investment credit, actual credit going towards businesses, is actually the lesser of all their activities. In fact, this type of investment, meaning when most of bank credit goes towards financing consumption, results in cannibalistic growth. That is, growth that doesn't serve to increase the productive capacity of an economy, but growth that only serves to increase the ability of an economy to consume its own produce at the expense of its own income streams, i.e., its future ability to consume its own produce. So, just to put a face to this name, so to speak, here is a diagram. On the left, we see credit directed toward production, and on the right, we have credit directed toward consumption. So, genuine growth is growth that both expands the production potential and the consumption potential of an economy by increasing the supply of goods and increasing incomes. Cannibalistic growth is growth that comes at the expense of previous genuine growth by stimulating the consumption of goods at their existing supply, not increasing either the ability of the economy to produce goods or incomes, but replacing income with credit and driving consumption as a ratio of productive capacity to a maximum, rather than actually increasing the productive capacity. So we see on the left, where credit is directed towards production, goods go up and wages go up, so therefore consumption can go up also. On the right, where credit is directed towards consumption, we have consumption increasing as a share of the goods available, but the total supply of goods available isn't actually increasing. And then in terms of wages, it actually places a negative pressure on, well, it doesn't really put a negative pressure on their wages, but it does put a negative pressure on their disposable income, because after they've taken on credit, they have a short upward boost, but they're going to have to pay interest on all their consumption. So it means that their immediate and constant costs have actually increased. Okay. Well, what about land? Because, we were just talking about land earlier. Recall what we learned about inflation specificity within the system of privately created money, right? So inflation specificity, that basically just means wherever a bank lends, that's where the inflation is going to be, right? Because banks create money, and when you create money, you raise prices. So if you create money in a specific sector of the economy, that's where prices are going to raise. Okay. And then B, the uniqueness of land and its sensitivity to increased demand. What we learned by combining these principles was that if credit was directed toward land to a certain degree, land prices would rise strongly and possibly invite speculative activity, thus increasing the price further, creating a positive feedback loop of credit directed toward land and rising land prices. So take this knowledge and apply it in the context of American economic policy, which is generally directed towards raising house prices as much as possible, which are based on land prices. Whereas consumer credit, directed toward normal things like cars, motorcycles, or luxury goods, might have a long-term effect of bringing investment into production of those goods, consumer credit directed toward land can't stimulate creation of further land. Right, so we say consumer credit in things like cars, motorcycles, and luxury goods might have a long-term effect of bringing investment into production. Well, hang on a second. Earlier we said that it doesn't do that it doesn't increase the supply of goods. You see on the right here, in our goods column, the only thing that's changed is consumption has risen as a share of total output. Well, what we mean by this is in the long term. So, in the short term, consumer credit does not expand output, it just expands consumption as a share of output. But in the long term, maybe the rising prices or the rising profits in those sectors of the economy which are most benefited by the consumer credit will invite investment from somewhere and will gradually and in the long term expand. But consumer credit directed towards land can't stimulate creation of further land. Though consumer credit in anything will raise the price of it, the inflation in cars or motorcycles could be mitigated by the increased supply that the increased demand might engender. Inflation in land prices will not be mitigated by increased supply. We know this is impossible. It can only be relieved by demand flagging off. Keeping all of this in mind, allowing a bulk of credit to go into land prices, mortgages, will result in higher prices and thus higher mortgages. Over time, all that will happen is that the size of the mortgage necessary to obtain housing will continue to increase. There is no return on this type of investment other than larger mortgages necessary. I say investment in quotes. Only banks benefit from this. Households are misled into believing that their house is their best investment. If land prices were disallowed from falling into this positive feedback loop situation, housing prices would be looked at as something, housing prices wouldn't be looked at as something that constantly rise. Thus, they wouldn't be seen as investments. They would instead be seen as costs of living, which is what they are. You know, the price you pay for your house is the cost of living. Okay. So yeah, that's investment in land. Well, there's another facet of investments to discuss, and that is long-term investments versus short-term investments. Investments can often be divided into the two categories of long-term and short-term. Long-term meaning that the capital will be remunerated only after a long while, and short-term meaning that the capital will be remunerated in a short period. As the period of delay before remuneration bears many different possibilities, which also bear opportunity costs, there are naturally things that make long-term investments less attractive to the investor. These things, namely, are uncertainty and risk. We have to now distinguish between the ideas of investing, quote unquote, on the stock market, which is what one does with one's savings to get them to grow, and investing in companies through either credit or the primary market, which is what one does with capital to get companies to grow. So stock market investment isn't really relevant to our discussion here. We're just talking about investment in businesses, real, genuine investment. So short-term investments don't bear the opportunity costs that long-term ones do. As the investor will have his money back in a short amount of time and will be able to dispose of it as he please shortly. Short-term investments also don't bear the uncertainty long-term ones do, as whatever short-term investment is being made is being done so in the context of current economic conditions. Long-term investments are made on the basis of future economic conditions, which are, for the most part, unknowable. Guessable, but unknowable. The further one goes into the future, and the further one goes from the knowledge of the factual current into the mystery of the future, the greater the degree of uncertainty there is. We can therefore say that investors making primary investments, that is, investment towards businesses, and not investment as savings, are disinclined to long-term investments, an incline to short-term investments naturally. Between long-term investments and short-term investments, the latter is more attractive. Okay. That's the investor side of investments. But what about the business side of the investment? Can we categorically state what kind of business purposes the different types of investment serve? Generally, yes. Short-term investment is usually useful for things like facilitating transactions, and long-term investment is usually useful for things like arranging and bringing together the factors of production. The former is commerce, the latter is production. The former promotes an economy's access to itself, whereas the latter increases the size of the economy. Stated in macroeconomic terms, short-term investments, while useful for the profitability of the firm, do not have the positive implications for an economy which long-term investments do, namely, increased output and income streams. Thus we see a conflict of interests between the economy at large and those of the investor. One wants long-term investments, and the other wants short-term investments. This paradox explains the existence of the various private-public partnership agreements that exist in many economies. The state agrees to guarantee a certain rate of profit, or a certain degree of privilege and protection, in exchange for the investor actually committing to a long-term investment. Why would a government agree to incur risks by making guarantees to investors? Because, without the guarantees, the investments would not take place. This can help to explain many things, in fact. Consider the example of the railroad construction epoch in American economic history. The railroads provided the basis for the country's explosive growth in the late 19th century, but the actual construction of the railroads involved massive amounts of giveaways from the government to the investors. They were given broad swaths of land surrounding the sites of the railroad, which they then held onto, waiting for the completion of the railroad to boost the value of the land, and which they then sold for a handsome profit. This scheme gave birth to the Harriman dynasty. So I guess that's about it for investment and finance. We're almost done with our series, so hang in there. And yeah, we hope to see you on the next video.